So wait until it's settled down to make a man to move along. It's trying to run where you belong, and maybe it's intentional, and maybe it's not bad at all. Wait, it's all.
Hi everybody, and welcome to Looking at the Markets with David Modell. I want to give you some important tips for swing traders. And by the way, if you want more help with trading, investing, swing trading, any of that stuff, you can email me anytime at davidmodell@gmail.com. So here's tip number one today for you. Before you buy or sell anything, it's not a bad idea to, in addition to all the other research you're doing, to check the insider buying and selling. And there are different places you can do that. Right now I'm just using FinViz, F-I-N-V-I-Z, finviz.com. And on the homepage, if you click on insider, that'll tell you, now there are no guarantees. I cannot guarantee the accuracy of finviz.com. They are not paying me to make this video or anything like that. No guarantees that this is accurate or not. But, for example, looking right now, I mean, if I thought about buying Facebook for a swing trade to hold on to it for a few days, few weeks, few months, something like that, I might think twice about it, because check it out. Mark Zuckerberg, the CEO of Facebook, September 30, selling shares. October 1st, selling shares. October 2nd, selling shares. 3 trading days in a row. Or not trading days, but just 3 days in a row, selling shares, thousands and thousands, millions of dollars worth of shares. He's selling them. Does that necessarily mean that Facebook's in trouble? Not necessarily. I mean, people sell for different reasons, but if you really believed that the stock was going to go up, you got to wonder, why is he selling so much in so many days in a row? I mean, that's not a great sign. Or here's another one, Twitter. If I was thinking about buying Twitter, I might think twice, because you have 2 different insider people selling, one day and then the next. You have a director at Twitter selling many shares, and then the very next day, the chief accounting officer at Twitter selling a bunch of shares. And so you have 2 different people right in a row, insiders in the company selling shares. That's probably not a good sign. Google, you got, again, a sale. All right. And it's not all necessarily bad. I mean, you might have, owners and insiders buying as well, and that could be a good sign. All right. So these are things to think about. I want you to add this to your list of things to consider, and it really doesn't take that long to check it. I mean, you could just, on this site, you could just go to the page and just browse through it and see, who's buying and who's selling what. All right, so that's a tip for you right there, in addition to all the other research you're doing. One quick point I wanted to tell you about: before you buy or sell anything, whether it's stocks or options, whatever it is, if it's on a company, you want to check to see when their earnings date, their next earnings report, is going to be. That's super important. And I'll show you an example of why that is. So here is KHC, Kraft Heinz Company, and I'm thinking about, let's say, selling a put option, because I want to buy 100 shares of Kraft stock at a lower price. Right now it's $26.59. Let's say I want to buy 100 shares at $25 a share. Okay, so I could sell a put option. And I'm looking at the expiration dates for the 25 strike puts that I want to sell. And I noticed that with the expiration date 1 month away, 30 days away, that's November 1st, I can sell for, let's say, $42 per contract. All right. So I could collect $42 right now in my account for selling a put option on Kraft Heinz that expires November 1st. And then I noticed that a week later, I could sell it for almost twice that amount. Not quite twice, but pretty close, for a lot more, $72. And I thought, wow, that's unusual. $42 for 30 days out. Or just a week later, $72. That's quite a jump in price. And I thought, man, I'll just sell this one, get $72. And I would just have to be in the trade for another 7 days, let's say, another week. But then I thought, wait a minute, why is this so much more expensive? It's because there's a lot more risk. Because look at when their earnings date is. November 7. That's the earnings announcement for Kraft Heinz stock, okay? And so there it is, November 8. Yeah, of course the November 8 expiration date is going to be more expensive. I'll fetch a bigger premium, because there's earnings in there on the 7th, and this expires the 8th. So if I sell the one from November 1st, then I won't have to deal with the possibility of a big earnings drop. All right, and so this is the safer way to go. And so I think I'd rather sell this, the one expiring before earnings, and only get $42 per contract, than sell the one that's after earnings. So I'll get more money up front, but I'll have to deal with big risk because of the possibility of a sizable earnings drop. That happens sometimes. On earnings announcements, a stock can go up a lot, it can stay the same, or it can go down a lot. And that's usually a risk I would rather not take if I can help it. So whether you're going to buy a stock, let's say you're thinking about just buying the stock and not dealing with options. Okay, I mean, if earnings is coming up soon, you might not want to buy the stock because it could go up a lot. Yeah, it could also go down a lot. And that sounds a little bit more like gambling and less like investing. If you're just speculating, right before an earnings announcement, if you're thinking it's going to go up a lot, it might not. And no one knows whether a stock's going to go up or down. No one knows whether it's going to be a beat or a miss with the earnings. And so that's just a quick point that I wanted to make right now. Here's another point I wanted to make. You don't want to buy at a high price, even though everybody's going to tell you to. Not everybody, but a lot of people. If you go on social media, if you go in some chat rooms, message boards, newsletters sometimes that people send out, I'll give you an example. All right, oil, okay, WTI, West Texas Intermediate crude oil, has been trading in a range from $50 a barrel to $60 a barrel for a long time. And so you've been able to buy in the low 50s or at 50 and then sell when it gets up near 60. You could just rinse and repeat that, do it over and over. But what did so many people in chat rooms and message boards and on social media do? When oil got up to 60, when it broke through 60, people got so excited. As you can see on this chart, went up to around 63 or so, 62 or 63. Everybody got excited. They said it was a breakout. It's breaking out of the range. That's not how it works, folks. It went right back down. This was based on a drone strike on Saudi oil facilities. But if you're going to play the range, play the range. If you're going to buy it around 50 and then sell it around 60 and just rinse and repeat that over and over, that's what you got to do. If you listen to the people who say, oh, went above the range, went above 60, it's 62, 63 now, it's going to go higher. Well, now you're buying at the top of the range. You're buying high, and you're going to end up selling low if you listen to those people. Now they're telling people to sell, some of those same people. All right, so you're going to end up buying high and selling low. I've got a better idea. If you missed the run up to 60 or 62, 63, it's okay. No one could have predicted that there was going to be a drone strike on Saudi oil facilities. I mean, come on, what trader could have known that was going to happen? And so you say, okay, look, it's at the top of the range. I'll wait until it gets back to the bottom or until it establishes a new range. I mean, if it went way above 60 and then it started to bounce between, 70 and 80 over and over, that would be the new range. But right now it's at the top of the range, and then it went back to the bottom now. It's getting closer. If it gets around 50, right now it's in the low 52s. Could easily get closer to 50, and then I might start buying, it could be either USO, which is an ETF that represents oil, or you could buy XLE, which is an energy ETF. That's another way to play that, or you can buy companies like ExxonMobil or Chevron, something like that. The purest play would probably either be get into the futures markets and buy oil futures contracts, or USO. Okay, this is just a chart of WTI crude oil per barrel price. All right, and as you can see, it is down, and that's what you get for buying at the top. Okay, I mean sometimes it keeps going higher, but that's not how this works. Not how the game works if you're going to buy low and sell high. So that's just a point I wanted to make. Don't be listening to people who tell you to buy when something is at the top of the range or breaking through the top of the range necessarily, unless there's a good reason to do so. And obviously there was not in this case. There are exceptions to this, of course, all right? So just wanted to make that point. I just wanted to make a really quick point here about the 3 trading day waiting rule, which I talk about so much. Here's an example, a textbook example. This is Schwab, SCHW, and yesterday Schwab announced that they're going to have free, commission-free trading, which is pretty cool. I use Schwab, so I'm happy about that. But as you can see, the investing community was not happy about that at all. Look at the size of that red candle, okay? And as I like to say, whenever you have a big red candle, there's a pretty good probability, not always, but a pretty good probability that the next trading day is going to have a medium-sized red candle, and then the next trading day is going to have a small red candle. And that this is textbook right here. It is happening because not everybody reacts to the news the same day. Some people wake up the next day and check their portfolio and see that the stock is down, and then they panic sell. Or they might do it 2 days later. And I mean 2 trading days. I'm talking about trading days here, so weekends and holidays don't count. All right, so did I jump in and buy Schwab on this day? No, and I'm glad that I did not. Okay, if I'm going to get in, then I'm going to wait until at least 3 trading days have passed, and since the big drop, so like today is day 1 after the big drop. And does that mean that I'm necessarily going to buy 3 trading days after the big drop? No, that just means I'm going to look at it, and I might consider buying it then, but maybe not. If it's still falling, probably not. Okay, so that just means that I don't even consider buying anything that has had such a huge drop in one day, such a big red candle, until I don't even look at it until at least 3 trading days later. Then I look at it and reevaluate and maybe consider buying it, possibly, or scaling into it. All right, so that's just a point that I wanted to make. All right, so I hope you enjoyed these swing trading tips. I hope they were helpful to you. Once again, if you would like help, if you want some coaching with trading, investing, charts, fundamentals, all that good stuff, you can email me for the coaching at davidmodell@gmail.com. And hey, if you like this video, why don't you show your appreciation right now by giving a thumbs up? And if you have not subscribed yet, why not do that right now? Subscribe to my channel and hit that notification bell on YouTube also. A lot of people forget to do that, and that's how you're going to get updates, so you'll know whenever I put out new videos like this one. Thank you so much for watching and for listening. I'll talk to you again soon.
So wait until it's said and done.